Welcome back. You're still watching World Insight. The program is coming to you live from Beijing. I'm Tian Wei. Many Chinese companies have listed on U.S. stock markets over the past few years. However, in the year 2019, data shows there were more than 150 Chinese companies that have gone public in the U.S. with a total market capitalization of $1.2 trillion. That's at least some of the numbers we have got hold of. But simmering U.S.-China trade tensions have brought pressure on those companies. Back in September, when the White House moved delisting Chinese firms from U.S. markets, Chinese company shares, including that of Alibaba and JD.com, fell sharply. Earlier this month, Chinese and American officials have had what described as constructive talks by phone on trade issues, but uncertainties still remain, if not more. So how will that have an impact on Chinese firms choosing their destination to be listed in stock markets around the world? For more on that and the latest of Alibaba's listing in Hong Kong, we are joined by Professor Jeffrey Townsend of Guanghua School of Management from Peking University. Meanwhile, in Brussels, we have Carol Lanoux, who is the Chief Executive of the Center for European Policy Studies. Last but not least, in our Beijing studio, Zhi Qiang, Assistant Director of the International Monetary Institute from Renmin University of China. Gentlemen, welcome to our program. Go to you first, Professor Townsend. Now, is U.S. still going to be an attractive place for Chinese companies despite of the latest geopolitics? Will Hong Kong and other places becoming more attractive than New York or NASDAQ?
Well, I think Alibaba did a smart move, which is characteristic for Alibaba because they seem to be perpetually smart about just about everything. You've got some rising political uncertainties between the U.S. and China. Access to capital markets is very, very important. They did some very prudent political hedging and opened up, obviously, another access point through Hong Kong. Very smart, very rational. But when you take it a little bit above that, it's actually a pretty nice story because on top of that very rational move, you have a nice story of a Chinese company coming home. There's a lot of symbolism in that. And I think that's has made this story quite nice, which you heard CEO Daniel Zhang talk about today.
Talking about it is one thing, but Mr. Townsend, if I could ask you directly, what does that mean for Chinese companies? Is Alibaba going to set a trend, as our previous panelists earlier trying to suggest?
Well, I think the one big winner in this story is Hong Kong. I mean, they've been trying to position against the NASDAQ, against these sort of, several hundred-year-old exchanges out of the U.S. where a lot of the tech giants are listed. And this was a big win for them. And I think it sets them up very nicely for, let's say, maybe Didi going public next year or some of these. There are going to be a lot of Chinese tech giants coming. There's a long pipeline of them. So. It sort of reversed some of the talk that people talked about 4 years ago about going to the U.S.
Yes. I see. Mr. Lanoux, your thoughts?
Yes.
Your thoughts also about that?
For us, let's say, I've seen from Europe, this is a different story. Of course, it shows that, as you were saying, as people before were saying, let's say, that China shows, let's say, that it can attract capital back home. But the most important story from a global perspective is that basically you see listings, the number of companies listed in the world is declining in the US, it is declining in Europe, but it's still growing in Asia and above all in China. The same with IPOs. You see IPOs overall at low levels in Europe, low levels in the United States, but growing strongly in China. So it shows for us very strongly, let's say, that the growth pool of the world is in Asia. and which is, of course, a clear warning to the rest of the world. Let's say that China, notwithstanding what we've seen in Hong Kong over the last weeks, notwithstanding with the trade frictions, notwithstanding, let's say, the discussion about is China a market-led economy, I mean, it manages to show that it can attract and grow strong companies in mainland China.
Interesting. Professor Chu, from your perspective, the other two guests have talked about it from, I guess, the Washington, in a way, perspective, and also the European perspective, if I could put it that way. Mr. Chu, how do you see the real nature of the latest move?
Well, I think this is the nature of both political choices and also economic choices. First of all, I totally agree with Mr. Lanou's viewpoint. That is, the companies getting listed has been reducing by numbers. But the reason for that is not actually there are fewer companies trying to get listed, but they cannot. Lots of companies trying to get listed in New York and Hong Kong, or even in Germany and etc. But since the economic cycle globally has recently been cooling down, so a lot of companies just cannot meet the standard. So they just cannot qualify. But on the other hand, there's a huge amount of money flowing around in the market. There being cash in people's pocket. People are just get burned. They will try to invest money out. So there have been very few good quality target for investment going on in there. So Alibaba, like quite a few of its counterparts, becomes the hot pursuit by a lot of the investment. So the Alibaba company and the other companies like Alibaba, they become, they get opportunity to be listed both in New York and in Hong Kong. Probably, if they want, can be listed in more markets.
Yes. So will that be the issue here, Mr. Lanou, that we see giant companies seeking dual listing, triple listing, and probably even more, as long as they can still get warm response from the market? And what would that mean for the market and the other companies that are trying to make their way up? Mr. Lanou.
We have in Europe less and less double listings because, of course, you have companies which used to be listed as well in the US and in Europe. But these days, the big problem for Europe with what they call this Capital Markets Union program is to grow capital markets in Europe. But so far, we haven't seen a trend, let's say, that Europe's capital markets are really growing. On the contrary, let's say we see more bank financing even growing rather than diminishing in importance. We continue to see the attraction of the US market for listings, like recently Spotify went to the US market, but others as well, and not as a dual listing, but as a single listing, because the US has such a pool of capital and is such a brand, if you're listed in the United States, that it's a key point of attraction for companies to be listed there. Of course, the China story fits a bit for Europe in a difficult way into this, but what I meant to say is that, again, US may be very attractive, but China, for us, is the wake-up call to say, look, this market or this region of the world is growing still extremely strongly, which you see as well with the number of listings, as with the IPOs, and certainly with the size of the IPOs. And I wouldn't say that it's only very large companies. I mean, the numbers were just mentioned before. Let's say you also have many other listings on the Hong Kong Stock Exchange, which are much smaller companies, high-tech companies, whatever. So it is, I mean, it's a very kind of attractive story for China, for Asia overall, but it's, again, a wake-up call for Europe and for probably also a bit for the United States.
Mr. Lanou is doing a lot of soul-searching for Europe right now. What about for you, Mr. Towson? I mean, is China significant still for the New York Stock Exchange and NASDAQ? Even given the geopolitics going on right now, will there be, as a result of tech companies, quote-unquote, forced to decouple from some of the most important areas, influence also the financial capabilities of the United States and China to couple together? Mr. Towson.
Right. I mean, there is this big question of decoupling, and, at one level it's a discussion of trade of products, at another level it's a discussion of technology. And then recently, in the last couple of weeks, we've heard the same idea applied to capital. Are we going to have U.S. pension funds not investing in Chinese companies listed in the U.S.? I don't really take any of that seriously. I think ultimately Alibaba is a great company. There's a lot of great companies coming out of China. U.S. capital, international capital, is going to find them one way or the other because it wants to. You know, they want to invest in great companies, and that sort of overrides a lot of the other considerations. So I think that's probably a lot of talk. I think the capital markets are going to stay free-flowing and without much impact. But I could be wrong.
Mr. Chu, you were attentively listening to your American counterpart talking about that. But, you know, when Mr. Townsend said, well, I might not take it that seriously about some of the earlier, you know, rumors of a certain withdrawal from the Chinese market or capitalization of some of the U.S. Possibilities. But, you know, to you, what does that mean, really?
Well, I think I agree with Professor Townsend. Actually, if you look at the data clearly, you will find out actually China has been opening up more to the foreign capitals. There have actually been more companies with more equities been holding in the foreign investors' hands. And I think also on the contrast, and Chinese companies are going out more and more. They're trying out. You see recently, just overnight, we see many Chinese companies try to get listed in New York and the NASDAQ. I think this is just a healthy way. So even though we're talking about there are some frictions between the two countries in the trade or etc., but actually the capital market is not lying because people with their real money is investing out. They're not fooling around their money, right?
Well, one could argue so, but the question really is how long-term is are people thinking about when they do the investment like this? Mr. Lanoux, even though you're from Brussels, but you have some insights about that as well?
About what? I didn't follow
about
your question.
How China
About
and the U.S.
specifically?
relationship really necessarily going to influence the financial markets, particularly.
No, but I would agree with what the other person said a moment ago. If the Chinese market is growing, if there are good opportunities there, pension funds may make some of a difference, but not too much, because in the end they want to diversify, they want to have good growth prospects. And if China continues to show, let's say, to the world that they can grow companies, that companies can be very profitable, they will continue to invest there. And of course, if there are some problems, they may be hampered to some degree by this, but this will not stop them too much. As long as the China market is really the benchmark, and as long as Hong Kong is basically the financial center for China.
Mr. Xu, of course, over the past few months, if you count back the past history, China has been making quite some efforts to open up its financial markets and also cooperation possibilities. Is that significant enough to lure more attractions from overseas investors?
Yes, I think so. China has been really opening up itself to the overseas market.
What do you mean by really opening up? Are there some specific things that you have in mind?
Yes, of course.
Like what?
For example, everybody knows the financial sector is a core sector of economy in any given countries. So in a lot of countries, they try to have some limit in their capital account, which means if you want to invest in some country's bank or brokerage companies, foreign capitals must have some limits, for example, like 40% or 49% or under. So you don't lose the control rights to some foreign investors. But right now in China, you see, we opened up this limit to the foreign capitals. And we see by the bond express or the security express, we allowed more foreign capitals coming into China. It's going to be a little bit risky, but it shows Chinese determination to open up more to the foreign capital and the market.
How attractive is it, Mr. Townsend, the latest?
The financial market is its own sort of world. It's a little bit on the periphery of definitely of my knowledge. When we move into sort of more the fintech world and, you know, something that's a little more tech related, yeah, capital's not the problem. I mean, it's the good companies are raising more capital than they probably should be, or should be raising probably.
Chinese companies, of course, are trying to list in many markets around the world, including the European and Asian stock exchanges. That at least have been some of the responses from the Chinese companies in the press coverage. So what would that mean? For example, companies such as Haier and Huatai have chosen to raise capitals using new overseas investment links as well. Is it part of the trend? Will U.S. still be attractive? Will Asian and European markets have a potential? Well, let's ask our panelists once again. Mr. Lanoux, I guess in this issue you have more say than your Chinese counterparts and also American counterparts, certainly.
Of course, but that depends on the growth prospects and on the overall governance in these markets. And of course, we see that, as I was just saying, Europe has been struggling to, build up a dynamic capital market. Of course, we have some very dynamic pools in Europe, let's say, but overall, Europe doesn't give the perspective of being a very dynamic capital market. US certainly is. But what I would say about China, what may be an issue of concern apart from the capital, is the state of the Chinese banking sector and the concerns which you often hear in the context of the Bank for International Settlements and other organizations, that there is a lot of non-performing debt or a lot of bad debt. And then secondly, probably related to that, is the role of state-owned enterprises. So there are certainly things in China which still have to be worked on, which has to do with opening up the system, making the system more transparent, applying fully the kind of reporting and accounting standards and auditing standards as we have in Europe and the United States, to basically make it even more attractive. So okay, for me, the big proviso behind further development of the Chinese capital market is essentially this: applying the rules which we have in place, certainly in the United States, but also Europe, to make sure that investors are sufficiently protected.
Mr. Chu, respond?
Well, I think it's going to be still very attractive. You know, there's a very interesting case in the world. Every time when the economy is shrinking or the cycle is going down, a lot of good companies are actually trying to use the stock market more to raise the fund. For example, uniquely, do you remember the big collapse in the Japanese economy of the 1990s, right? There's no banker willing to lend money to the Uniqlo, a young company, try to open up a lot of branches. In investors' mind, this is just suiciding. But Uniqlo, against all the opinions, no matter what, they still try to get listed or raise the capital in the market. And look at the Uniqlo, how successful they are right now. And only when in this down cycle, the stock market and the one who dare to swim in this market is actually the one who have the confidence. Well, because when there's a huge amount of money flowing in the market, because everybody is floating, you really don't know who is the right swimmer, who knows actually how to swim in the waves. But when the market is going down, when the economy is going down, the true dares can really swim in the market, and you can easily pick up the good swimmer.
Interesting. Mr. Towson, do you agree with that? It's all about the qualities, and as long as you have the guts.
I think for a lot of the Chinese tech companies coming up, the rule will just be, when in doubt, copy Alibaba. So list in the US, list in Hong Kong. That's a good, solid solution. You know, get back to business.
As simple as that?
Yep.
Mr. Lanu, do you think that is the viable way?
I think it's a bit more, as I said, let's say there is a lot more homework which has to be done, let's say, just to manage to imitate what Alibaba has done. You have to imagine, if you go to the US capital market, you're supervised by the SEC. The SEC, the Securities and Exchange Commission, is the most stringent supervisor for capital markets in the world. So if your accounts are not in order, or you don't respect investor rights, you will have a problem right away. So I'm sure Alibaba has the size that they can cope with this, but I'm sure there are many other companies who cannot do this. Hence my plea, let's say, that there is a lot to be done, probably homework to be done by the Chinese, just to make sure that their market also on supervisory standards, accounting standards, auditing standards, role of boards, is up to the standard as we know it in the United States, and to some degree in Europe.
Is also your argument, Mr. Chu, that, if I understand it right, China market is attractive enough, China's potential is attractive enough, whether the areas that Mr. Lanu keep on talking about are going to be addressed in a way that even the Europeans, every one of them, will be informed about the progress. Is it necessary?
Well, yeah, I do think so. But right now we're actually talking about Hong Kong. I think Hong Kong is actually a temporary good choice for both sides of the market. For example, right now in Hong Kong, probably they have the most solid and complete standards and accounting method and also regulations among all the Asian markets. So when a Chinese company try to list in Hong Kong, so they have to, to examine themselves more thoroughly and to be law-abiding even more. So this is a good learning curve before they try to go to New York. And also for the companies like Alibaba, when they go back to Hong Kong Stock Exchange, also they're using very similar accounting standards and the regulation method. And also I think there's a multiple win situation. For example, there's a lot of Chinese capitals flowing around through the Shanghai-Hong Kong Express or the Hong Kong-Shanghai Express method. And then they have a chance to invest in a good company, good quality company like Alibaba in Hong Kong. And the Hong Kong investors, they do also have the choices. And also don't forget the #1 capital holder in the Hong Kong Stock Exchange is American capital. So they also get the share. So it's a good stabilizer for the Hong Kong market since Alibaba's quality. But the only one thing we have to note is that don't overinvest, because no matter how good you are, there's still the danger of overinvesting and overheating.
Mr. Towson, the underlying meaning of your early remarks seem to suggest that people know where the money should go, and people know where the qualities are, and people know, particularly investors know, where the potential is, despite of all of these apparent geopolitical conflict. Is that what you're trying to say?
Within the tech world, which is, Alibaba, the Tencent, Didi, this world, I mean, these are very unique companies, and they're coming out of a couple places in the world. They're coming out of Silicon Valley, they're coming out of parts of the U.S., they're coming out of China. These companies are kind of a peer group. There's good reasons to list in Hong Kong, there's good reasons to list in the U.S., regulations, access to capital, all this. But also within this, there's a peer group. Alibaba and Amazon are similar. Google and Facebook, they all want to be sort of in the same grouping, and they all want to be basically international tech giants. So there's a lot of value in sort of being in that cohort. So I would expect the Chinese companies that are rising quickly, especially in tech, I would expect a lot of them to dream of going international and listing in the U.S. I think that's going to stay. And I think a reasonable sort of companion strategy is also to list in Hong Kong and cover both your bets there.
Right. Well, we have to wrap it up. Final words from every one of you. What shall we expect as a result of Alibaba's apparently successful listing in Hong Kong Stock Exchange? Mr. Lanu, very briefly, 20 seconds.
No, but on the one hand, let's say all we heard about Hong Kong over the last weeks is only a secondary issue. Hong Kong keeps to grow and keeps to attract capital. And I think the story will continue.
Mr. Towson?
I think they're going to use a big pile of money and get into a bit of a war with Meituan on food delivery.
And last but not least, Mr. Chu.
Good news for all the investors. But hey, watch out, Tencent. Your enemy comes into your backyard.
Wow. There's a lot of warfare analysis over here. Well, thank you so much for the three of you helping us to understand the latest. Chu Chang, Jeffrey Towson, and Carol Lanu. Really appreciate it.